Mortgage rates are like onions, nothing but layers, and once you start chopping them up, they might make you cry. But we're hoping to keep the crying to a minimum, so let's put on our glasses and get to chopping. I'm going to go over 6 different layers that influence, correlate, and help drive mortgage rates. These are going to be stocks or the stock market, the Fed, or you'll hear the term Federal Reserve, inflation, quality of credit, the 10-year Treasury, and then just normal daily events such as economic reports, auctions, and even world news. My name is Leah, and I'm going to be your chef today. Also, mortgage broker and certified mortgage advisor. And if you find this video helpful or just randomly entertaining, please like and subscribe. How many times do you hear people out there predicting mortgage rates? They're gonna go up, they're gonna go down, the news and media says one thing, your Uncle Bob says another, and maybe your pet cat even has their own opinion because everyone does. But how do you know which of these opinions and predictions are the ones to listen to? Which ones are based on highly educated guesses and which ones are based on, well, flub? You do this by understanding what forces influence and drive mortgage rates. If you know and understand that, then you'll much better be able to understand and guess which one of these predictions is probably more accurate than others. Let's start with our first layer, the stock market. Now, to really understand how the stock market and mortgage rates, how they kind of influence and work with one another, let's first define what stocks are and what bonds are. A stock represents a share in the ownership of a company, including a claim on the company's earnings and assets. And bonds are fixed income instruments that represent a loan made by an investor to a borrower. Stocks are considered more risky. However, they also tend to yield a bigger reward, whereas mortgage bonds are considered to be a safer option. However, though, they don't yield as much of a reward. This is an important concept to keep in mind because this plays a factor in how stocks and mortgage bonds work with one another. They have an inverse relationship, and this is because they typically are going to compete for the same investment dollar. Let's look at an example. Stocks and mortgage bonds tend to compete for the same investment dollar, and this is why they have that inverse relationship. How does it work? When the economy is doing really well, people feel good and they feel like they can take on a greater risk to try to yield a bigger reward. So what happens is investors, when the economy is doing well, will move their money out of mortgage bonds and into stocks. This brings the price of mortgage-backed securities down and brings interest rates up. But then it's also the opposite. When the economy is doing poorly, investors want to move their money into less risky investments. So they'll take them from stocks and move them into mortgage bonds. This brings up the price and then in return lowers interest rates. The second layer is the Federal Reserve, or as I like to call them, the Fed. Let's break one myth though, right out the gate. I hear all the time people say that the federal funds rate is the same thing as mortgage rates. Anytime the Fed raises the federal funds rate, I automatically know I'm getting a call from at least one person saying, Leah, my interest rate is going up. Not necessarily. Easy example, if you guys remember when the Fed dropped the rate to 0 back in 2020, and I'm talking the federal funds rate to 0, did mortgage rates ever hit 0? I don't think so. They did drop, they dropped low into the 2s and the 3s, but they never actually hit 0. Now, the Fed does play a pretty big role, though, in influencing the direction of mortgage rates. Going back to 2020, the big reason why they dropped into the 2s and the 3s was because the Fed was doing something called quantitative easing. This is where they went and they purchased billions of dollars in mortgage-backed securities. Because of this, it drove the price of mortgage-backed securities up. And when the price of mortgage-backed securities goes up, mortgage interest rates come down. And then when the interest rates spiked again, right, up into the 7s and the 8s, well, this is because the Fed was doing something called quantitative tightening. They stopped purchasing mortgage-backed securities, and then they did something called balance sheet runoff. And this is a topic I'm going to do a whole nother video on because I want to get to our other onion layers of mortgage rates today. But the Fed and how it interacts with mortgage rates is actually a pretty cool concept. It's really interesting to learn about. So be on the lookout for that video as well. Our third onion layer is inflation. Da, da, da. I get it. Inflation sucks. Especially now, everything is so much more expensive. It's really annoying, but it is what it is. What is inflation? Inflation occurs when there are too many dollars, too much money, chasing too few goods. Supply and demand. It's part of what we're seeing in the housing market right now. We have low inventory, but high demand, and it's continuing to drive home prices higher. Now, how does inflation play a role with mortgage rates, though? It's actually the arch enemy to mortgage interest rates. Why is that? Because mortgage bonds offer a fixed rate of return to the investor, and inflation erodes away that power. Let me show you an example. Inflation is the arch enemy to mortgage bonds. Let's say an investor has $100,000 in mortgage bonds. Now these get a fixed rate of return. So in this case, let's say they're getting a 4% fixed rate of return. This comes out to be $4,000 every year. Now, goods and services, let's say in 2023, currently cost someone, let's say they cost $1,000 per year for goods and services. Now, as inflation starts to come into play, those same goods and services that used to cost $1,000 per year are now costing the same person $2,000 per year. But they're only getting $4,000 for their fixed rate return. In order to offset the inflation, interest rates will go up. Our fourth little onion layer is quality of credit. In my opinion, I think this one is a little more self-explanatory than some of the other ones, but let's still look at it. Now, rather than big picture, I think this one is easier to understand in a small picture. Let's take two people, for example. Both getting mortgages, let's say everything on their loans is exactly the same, except different credit scores. Borrower A has a 800 credit score, and borrower B has a 680 credit score. Well, you guessed it, borrower B with the 680 credit score is going to have a higher interest rate than borrower A. This is because that person is considered to have a greater risk of default, just meaning there's a greater risk that they may not pay their mortgage. Investors want something to offset that additional risk they take on. And they do that by making the interest rate, the mortgage rate, higher. Number 5, the 10-year Treasury. And treasuries are backed by the full faith and credit of the US of A government. Yeah. Basically, the 10-year Treasury, or treasuries in general, are considered to be pretty much risk-free, safe. And the 10-year Treasury is actually the most closely watched government debt instrument. It's also correlated with mortgage interest rates. Now, on a micro scale, they don't necessarily move step by step. So you can't always, on a small scale, assume that the 10-year Treasury and mortgage rates are going to move together. But in the long run, they do tend to move step by step. This is because they compete for the same investment dollar. Let me show you an example. The 10-year Treasury and mortgage bonds compete for the same investment dollar through a phenomenon called convexity buying. Imagine you're a bond fund manager. Now your fund has to have a certain duration, and mortgage rates, or mortgages just as we know, have an early recall piece to them. People can refinance out of their mortgage before it comes due. Why is this important? This is important because when a mortgage is refinanced early, then there's still a certain duration that needs to be met in the bond fund. So what'll happen is these bond fund managers will move or purchase more 10-year treasuries because these do not have an early recall period to them. So it's going to add a little bit more security. However, when there's a drop in the yield on the 10-year treasury, this causes a larger spread against the yield on mortgage bonds, which actually makes mortgage bonds much more appealing. And when mortgage bonds become more appealing, well, you guessed it, investors will move their money from the 10-year treasury into mortgage bonds. This brings the price up, which lowers interest rates, which then leads to more refinances and starts the cycle all over again. And to finish out, we have our 6th and final onion layer. This is going to be just daily occurrences. You guys might not know this, but pretty much every day there is some sort of economic moving factor or data or news that comes out. So these can be things like economic reports, anywhere from new home sales, maybe the BLS jobs report, inflation reports, etc. You have all these economic data reports that come out all the time, and these things can be market moving for interest rates. Same if there's treasury auctions or note auctions. Those things can also play a factor in which direction mortgage rates go. And world news too. Believe it or not, this was a really interesting thing that I learned as I got more and more into the mortgage business, is that the world is so much smaller and more interconnected than you would think it is. Something that happens in another country, especially if it's big and market moving there, almost always is going to have an impact on our markets here. It's kind of crazy. There's days where the mortgage interest rates are going one way and I have a pretty good grasp on, yeah, this is kind of what they're doing. This is what I expect them to do. And the next morning I come in and something happened over in London, in England, or wherever, and now it's completely thrown off where our interest rates in market are. So it's just something to pay attention to and watch out for. The crazy thing is we can continue to pull these layers back more and more. But understanding your little onion, mortgage rates, is going to help you become a better predictor of which direction they might go. And if you can predict within reason the direction mortgage rates might go, you also might become a better predictor of what may happen in the housing market. But for now, I'm tired about talking about onions. I really just want a cookie and I want to enjoy the rest of the evening. And if you don't want to miss out on learning about all those other layers, make sure to hit that subscribe button. That way you never miss a video. I hope you guys also have a great evening. Have a cookie, not an onion.